Buying a home can be tricky. I mean, you have to know how to find the right property, you have to know how to not overpay for your home, and you have to know how to not overpay for your mortgage. And in this video, I'm going to be going over the best ways to buy a home. What's up everybody, I am Jaspreet Singh from theminoritymindset.com, where money minds rethink rich. I have seen or been a part of dozens of home buying deals, some as a real estate agent because I used to be a real estate salesperson, some as a real estate investor, and some on the legal side because I'm also an attorney. There are some parts to the home buying process that you'll be able to read in books. Like every book will tell you that you want to buy a home in a good area because buying a home is a long-term investment and you should always get a building inspection. But there's also going to be things that you deal with that you won't find in books. Like what happens if you buy a home and then you find out that the sewage line is filled with cement because the person that used to live in this property took cement and they poured it down the main sewage line. True story. It was a situation I had to deal with at one of my investment properties, and I'm going to show you in this video how you can avoid running into these type of situations. If you do want to see what happened and learn more about my worst real estate investment deal ever, I'll link that video for you in the description below. There's 5 things that I need you to understand when it comes to buying a home, especially right now, and these are the 5 things that I'm going to be going over in this video. First, I'm going to be talking about how to find the right home. How do you know where to look, and how do you know if you can afford the property? Second, you got to understand how to get a mortgage because most of us don't have $500,000 of cash to go out and buy a home, and so you got to get a mortgage. So you want to know how to get a mortgage the right way and not overpay. Third, you got to understand the market because the real estate market is in a very weird place right now. Fourth, you want to know some kind of hacks when it comes to buying the property. That way you don't get screwed over and you don't run into a lot of problems when it comes to actually buying your home. And then fifth, we'll talk about repairs because if you're buying a home, chances are you might need some work done on that property and you want to make sure you're doing it the right way. So these are the 5 things that I'm going to be going over. But before I do that, I need you to do me a quick favor and smash that thumbs up button below. Let's start by talking about finding your dream home because there's 2 things that you need to pay attention to when it comes to finding your dream home. First, you got to find the right location, and second, you got to find the right price. When you hear about someone falling in love with the home, there's way more to falling in love with the home than just the property. You also have to fall in love with the location because depending on where the location of the home is, you can buy a much bigger or much smaller home. Like you can buy a mansion in the villages of Utah for like $300,000. But if you go to New York or if you go to downtown San Francisco, $300,000 is going to buy you a closet. Some locations are going to be better than others, and you got to prioritize what's important for you. I mean, do you want to be near good schools? Do you want to be near your work? Do you want to be far away from everything? This is going to play a part into how expensive the home you want is going to be because the further you are from everything, the bigger home you can buy for less price because as you go into kind of the more rural areas, things just get cheaper. You really want to have a good real estate agent on your side when you're looking at homes because a real estate agent's job is not only to help you find a good city to be in, but they'll also know what neighborhoods and what part of the city you want to be in and what areas that development is coming into because real estate is a long-term game. When you buy a home, you're probably not planning on being there just for 6 months. You're probably planning on being there for years. And so you want to be in a place where developments are coming into, where people want to be, and where property values will hopefully go up in the future. You don't want to buy a home into an area that is sinking, that is just becoming crappy, where people are moving away from. The way real estate agents get paid is they get paid on commission, and real estate agents are typically paid by the seller. So if I'm selling my home for $100,000, I might be paying $6,000 in commissions to the brokers. And the $6,000 is going to be split between my listing agent and your buyer's broker. So they get $3,000 each. Now, if you don't have an agent, now typically what will happen is my agent, my listing agent is going to get a bigger bonus. So instead of getting $3,000, they might get $5,000 or maybe $6,000, the entire 6% commission, just depending on what they negotiate with me. So it's really not that big of an advantage for you not to go through a real estate agent because if you don't go through a real estate agent, the seller probably is not going to give you that big of a discount. So it pays for you to have a good real estate agent on your side because they can help you find a good location and they can help you negotiate the price of the home because they're going to understand the market way better than you do, or at least they should if they're a good real estate agent. Now, as you're trying to find this dream property that you can fall in love with, the next thing that you want to make sure you fall in love with also is the price, especially in this market, because you want to make sure that you can afford the home that you live in. I'm going to talk a little bit more about this when I get to the market section, but it is very, very, very important for you to make sure that you can afford your home no matter what your real estate agent says, no matter what the bank says, no matter what the government says, and no matter what your cousin Bunty says. You want to make sure that you can afford the home that you live in. That way, if the economy slows down or if something happens to your finances, you want to make sure that you can still afford the home that you live in. So this is very important, and there's a couple things that you need to understand when it it comes to affording the home. You got to afford the down payment, and you also got to be able to afford the monthly payment. And I'm going to go over both of these monthly. If you really want to be able to afford the home that you live in, then you want to be putting down a minimum of 20%. Now, I know 20% seems like a crazy down payment, especially nowadays because home prices keep going up and because you can get a mortgage for 3 to 5% down. But the reality is the more down payment you put down, the less you're going to have to pay in your mortgage over time and the more equity you have in a property. So if something were to happen to the economy, you're still okay. You own a home with skin in the game and you have equity in your property. And plus, if you have more equity in your property, then you don't have to worry about paying certain insurance fees and other fees that the bank is going to charge you. So you can save on those if you just put 20% down, and it can help you get good interest rates on your mortgage. I'm going to be going over mortgages in just a second, but if you really want to be able to afford your home, then you need a 20% down payment, and your monthly payment, you want this to be something like 25% of your income. So banks are going to really try to stretch this, where they might say that your kind of monthly payment can be a third of your take-home income, but you definitely want to have a little bit more of a cushion there, which is why I like to say you want your mortgage to not be more than a quarter of your income. That way you still have money to put aside towards your investments and towards your savings and towards your future and towards your fun. So you don't want all of your money going towards your mortgage. Your future self will thank you if you keep it around a quarter or less. Now, as you're starting to calculate how big of a home you can afford, the next thing you want to understand is that before you actually start looking at homes, you want to get pre-qualified, because the last thing you want to do is you fall in love with a home and then you go to get a loan and you find out that you cannot get approved for a loan, and now your spouse is going to be heartbroken, your kids are going to be sad. So get pre-qualified before you start looking at properties. You're going to save your family a huge headache, and you're going to save your real estate agent and the listing agent and the seller a major headache. Second, if you don't want to overpay for your mortgage, you got to understand the different mortgage options you have. The most common mortgage options out there are a conventional mortgage, then you have an FHA mortgage, a VA mortgage, and a USDA mortgage. These are government-backed mortgages. This is not. If you want to qualify for a conventional mortgage, then they typically are looking for a 20% down payment. Now, nowadays, you can get a conventional mortgage for 3 to 5% down, so you don't really need that whole 20% down payment. But the thing that you have to understand is that if you don't have 20% down, then the bank is also going to charge you PMI, which is an extra insurance kind of fee that the bank charges you because you don't have that much equity in the property. So just understand that yes, you can get a conventional mortgage with less than 20% down, but if you put less than 20% down, you're going to have to pay an additional fee on your mortgage called PMI. And to qualify for a conventional mortgage, you have to have a minimum credit score of 620. But if you want to get the best rates from a conventional mortgage, then you really want to have a minimum of 740 credit score. Qualifying for government-backed mortgages have less strict standards. So if you want to qualify for an FHA mortgage and you have a 580 credit score or more, then you could put down 3.5% on your mortgage down payment. We draw a line here. And if you have less than a 580 credit score, so 580, less than a 580 credit score, then at the time of me recording this video, you're required to put down a minimum 10% down payment. Now, just one thing you want to understand is that these down payment requirements can change, same with the credit score requirements. This is just what it is at the time of me recording this video. The second thing that I need you to understand about FHA mortgages is while you don't got to worry about PMI, you do have a separate insurance fee that you have to pay, even if you have 20% equity. So just understand that, yeah, you can put down a smaller down payment and you can have a lower credit score, but you're going to have to pay this additional insurance fee every single month. A lot of times what you'll see happen is if somebody doesn't have the best credit score and they want to buy a home, they'll come in and get an FHA mortgage. That way you can get this home with a lower credit score requirement, and then once you have 20% equity in your home, that's when you can refinance out and get a conventional mortgage. That way you don't have to worry about paying this insurance fee anymore, and hopefully you have a lower mortgage rate. That way your mortgage payments will drop. Now, the thing that I want you to understand is while this is good in theory, if home prices drop, then it can be much harder to really do that, because if home prices drop, it can be harder for you to refinance out of your home. So I just want you to keep that in mind, because while home prices might look like they always go up, home prices do not always go up. So you want to always make sure you're prepared, which is why, kind of like I talked about before, it is better to be safe than sorry with a larger down payment in the beginning. If you want to qualify for a VA mortgage, that's the Veterans Affairs mortgage, then you have had to have served the country in some way. Maybe you had to be a part of the National Reserves or the National Guard, or you had to be a part of the military. So that's a different eligibility thing that you want to take a look at. But if you qualify for a VA loan, then you have to put 0% down. You don't have a down payment requirement. And the credit score requirement is generally somewhere in the range of 580 to 620. Sometimes it's less, sometimes it's more, but that's kind of the general credit score that they're looking for minimum for a VA loan. And while you don't have the general insurance fee like you do with the FHA mortgage or PMI with a conventional mortgage, you do have a VA funding fee that sometimes people will put on the back of their mortgage. So just understand that while you don't have that insurance fee, you do have a funding fee that you have to pay with the VA mortgage. And then finally, we have the USDA mortgages. These are only for rural homes. And with the USDA mortgage, you can buy a property with 0% down. And typically, they are looking for a 640 minimum credit score. Again, this can change, but in general, they're looking for a minimum 640 credit score. And yes, you do have an insurance fee you have to pay with USDA mortgages as well. So this is kind of like a general overview of the main kind of types of mortgages out there. But if you want to get the best interest rate possible on your mortgage, there's 3 things that you want to do. 1, you want to have a bigger down payment. That way you can avoid paying these extra fees. 2nd, you want to have a good credit score. The better your credit score, the lower your mortgage rate is going to be. And 3rd, you want to make sure you're shopping around, because some lenders are going to charge you a whole lot more for the exact same loan as someone else. So you want to make sure you're shopping around. The good news for you is it is easier than ever for you to shop around for mortgage rates and refinance rates without hurting your credit score thanks to the internet, because you can just use a mortgage comparison tool. And the following is an advertisement from our sponsor Credible, who operates a mortgage comparison website. At Credible, you can check pre-qualified mortgage and refinance rates at no charge to you. They have multiple lenders competing on their marketplace, so you can compare great rates and pick the option that's best for you. It's a pretty simple process. All you gotta do is go onto Credible's website and enter in a few pieces of information, which just takes a few minutes, and then Credible will present you with actual pre-qualified rates from different lenders. That way you can compare. Their pre-qualification process is easy to use. It only takes a few minutes, and checking pre-qualified rates does not affect your credit score. So if you want to see what mortgage rates or refinance rates you might qualify for, I got the link to where you can do that with Credible in the description below. Credible does pay minority mindset and advertising fee when you submit a pre-qualification request, and Credible Operations Inc. NMLS number 1681276 is not available in all states. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I got the link to where you can do that with Credible in the description below. Once you understand the property and you get pre-qualified and you understand the mortgage process, the 3rd thing you want to understand is the markets, because real estate prices are cyclical. There are times when real estate prices are going up, and there are times when real estate prices are going down. Real estate prices don't always go up, and they don't always go down. So you want to understand the difference between a buyer's market and a seller's market. An example of a buyer's market is what we saw happen after the 2008 real estate crash. After that crash, everybody was selling their homes. You had a lot of people getting foreclosed on, and other people just were selling to get out. And so you had a lot of people selling and nobody buying. This created a buyer's market, because now if you wanted to buy a home in that environment, you had no one to compete against, because nobody wanted to buy a home. And so you were able to get a great price on a home, which is why it was called a buyer's market, because everybody wanted to sell you their home and nobody wanted to buy. So you had a lot of negotiating room and leverage. A seller's market is what we're experiencing at the time of me recording this video. We entered a seller's market right after the 2020 pandemic and recession started, because now you had all these people that wanted to buy a home and take advantage of these low interest rates, and you had very few people selling a home. So when you had all these buyers and no sellers, now the buyers are having to fight against each other for the small inventory of homes available for sale, and this pushed home prices up. One of the most common responses that I get when I talk about buyer's markets versus seller markets is people say, oh yeah, I want to buy a home, but I don't want to buy in a seller's market, so I'm just going to wait until a buyer's market. And sure, that can work just fine, but the problem with that is you don't know how long you'll be waiting. Like, we don't know how long these real estate cycles will last. And so yeah, even if we are in a seller's market right now, we don't know how long we're going to be in a seller's market. We don't know how long the real estate market is going to continue booming in this trajectory. And so it's impossible to predict that, which is why if you want to buy a home, that's fine. But you got to remember the first thing that we talked about. You have to be able to afford the home that you're buying. That way, even if home prices go down, you are okay. One of the biggest mistakes that people make when it comes to buying a home is they think that their home is an investment, in the sense that, okay, I am going to make so much money off of this home, so I am going to go deep into debt and I'm going to buy the biggest home possible, because I am going to get rich when I sell this property. And so people stretch themselves way too thin to buy a home that they cannot afford, because they think that this home that they're living in is going to make them rich. But the home that you're living in is not an investment. If you really wanted to buy an investment, buy a rental property, buy an investment property. The home that you live in is a utility, is something that you're using, okay? So you got to understand the difference. Sure, you can make money off of the home that you're living in. If you buy it at a good price and home prices go up, that's great. But I don't want you to buy it with the mindset of trying to get rich off of your home. I want you to buy your home with the mindset of using your home as a home to raise your family, to live in, okay? When you have that mindset, then you're going to understand, okay, I got to buy this home so I can live in there, and you got to make sure that you can afford it. When you do that, it doesn't matter what market you're in, you're buying a home because you want to use it, and you're going to make sure that you can afford it first. And when you understand what kind of market you're in, whether you're in a buyer's market or a seller's market, it's going to change the way you negotiate deals. After the 2008 crash, when we were in a buyer's market, I never paid full asking price. I was always negotiating hard. Now, when I'm looking to buy investment properties in a seller's market, I'm a lot of times paying more than asking. I just made an offer today at about $10,000 over asking price just because that's the market that we're in. Fourth, when you find a property that you love, there's a few things that you want to do that way this property doesn't turn around and bite you in the you know what. The first thing you want to do is protect yourself legally, and I'm not just saying this because I'm an attorney. So you want to have an attorney on your side that is going to review your purchase agreement. That way you can make sure that all the kind of protections you need are in the contract. Second, this attorney is going to help you review your mortgage documents so you really understand what's going on in your mortgage, and they're also going to help review your title documents and your title insurance. You have to have title insurance. If you don't know what that is, essentially title insurance protects you. That way when you're buying a property, you actually are buying this property, not something else. So title insurance protects what you're buying. And so you want to have an attorney on your side to kind of decipher all this stuff, because real estate contracts can be very confusing. And I know attorneys can be expensive, but it's a small price you pay today to protect you against a huge headache in the future. Second, when you're entering into contract to buy a property, you always want to negotiate a due diligence period where you have 7 days or 10 days minimum to go through the property with your own inspectors and kind of just inspect the entire property. And so when you're negotiating the contract, you want to make sure you have a minimum 7-day contingency clause. I like at least 10 days, but at least 7 days, where now you can bring in your property inspectors and really just walk through the entire property. And when it comes to inspections, the more inspections, the better. So I would say at a kind of very least, you want to have a building inspector come out. A building inspector is going to look at the entire property. They're going to go on the roof. They're going to look at the basement or the foundation of the property, whether it's a crawl space or a slab. They're going to look at the plumbing, the mechanical, all of that. And you also want to have a sewage line inspection. So kind of like what I talked about before, I bought one investment property where I did not do that. I did not get a property inspection. That was the only time I didn't do that. And it turns out that after I bought this property, we were having a lot of plumbing issues. Turns out that somebody that was living in this property before, we think it was a tenant, they didn't like the landlord, and so they took cement, and they poured it down the main drain. And so now when we found this, we had a huge expense because we had to bust out the cement in the basement until the main drain, the main city line, and we had to fix it, redo the plumbing, and then re-pour down the cement. You don't want to run into issues like that. So you want to understand how the sewage lines are looking. Maybe there's roots in there. You might not have cement, but there could be other issues, tree roots that are getting into your main sewage line. So you want to understand this before. And so if you get a main sewage line inspection, then someone's going to come in with a little camera and they're going to run this down to make sure your sewage line is okay, and your property building inspector is going to look at everything else. So at the very least, you want to get that. You can also get a mold inspection, a termite inspection. It really just depends where your property is located and what kind of property you're buying. Your building inspector can help kind of guide you. That way you understand what kind of property inspections you need, and your real estate agent should be able to help you with that too. And when you're trying to calculate how much money you need to buy a home, you do not want to forget the moving costs, because moving into a new home can be expensive. Especially if you have a lot of stuff. You gotta hire movers, and you gotta sell some stuff, and you might need to buy new furniture, you need to buy a new TV, you gotta buy more stuff. And so you wanna make sure you understand these moving costs before you go in, because if you are pulling every dollar you have out of your bank account to buy the home, and then you realize, oh, I gotta move to this new property, you don't have money to hire a truck or to hire movers, and now you have no money for furniture, you're going to run into a problem. So just factor this in there. Remember that, yeah, you got to buy a home, but you also got to factor in your moving costs. And number 5, let's talk about maintaining and repairing your property, because what you're going to see happen is when you do your private building inspection, your inspector is going to walk through the property and they're going to give you a whole report of a lot of things wrong with the property. Now, chances are a lot of these things might not be a big deal, but there could be some major things wrong with the property, and you got to understand, is it still a good deal for you if there are major issues with the property? And so this is where you got to kind of calculate that. One thing that you can do at this point, because your sellers are locked in, is you can go back to the sellers and say, hey, there's a lot of work at this property. I don't know if I want to go through with this deal. Would you be able to work with me on the price? Can you bring the price down by $3,000 because we have to make all these repairs? So it's kind of like a secondary negotiating point because now you have this leverage. The sellers are on the hook, you're on the hook, you want to buy the property, they want to sell you the property, and now you have these extra repairs, and you can say, hey, give me a break on the price because if you don't, then I might just walk away. Now again, a little bit of caution when you do that. Consult with your real estate agent before because they're going to understand the market. If you're in the seller's market, it's going to be a lot harder for you to get big concessions from the seller after you've entered into the contract, because if there's a lot of buyers out there, then the seller might just say, no, we're not going to do that, and they're going to sell the home to somebody else because they know that there's going to be so many offers and maybe they have backup offers already lined up. So you really kind of have to just understand the market, and this is where having a good real estate agent can help you with that. But whether or not you get these concessions and you want to make repairs, the next thing I want you to understand is you got to use a licensed contractor, because when you're talking about making renovations for your own home, the last thing you want to do is run into a situation where you give someone a $5,000 check to start some work and then you never hear from them again. If you're not really familiar with how to do renovations or how much work is involved, you want to work with somebody who is reliable, because the last thing you want to do is just trying to find the cheapest person, because sometimes the cheapest person you work with can also end up being the most expensive, because if they don't do a good job, you might have to start that work all over again. So now you're paying not only for them to do a bad job, but now you got to pay somebody else to take their work away and then redo all of the work. I've run into that issue multiple times in the beginning when I was not working with reputable contractors. So that's one thing that I want you to keep in mind. And the second thing that I want you to keep in mind is when it comes to doing these repairs, whether you're in a buyer's market or seller's market, is going to affect how much money you're paying for these repairs. Because when you're in a buyer's market and everyone is selling their homes, especially when they're having to cut the prices on their homes, then you're not going to see that many people renovating their homes. Typically, you're in a more recessionary environment during that time. And when you're in a recessionary environment, then people are looking for work. And so contractors are going to be more likely to work, and they're also going to be willing to give you a lower price on work. And so when you're in that type of buyer's market, you're going to get better deals. But when you're in a seller's market, now everyone's trying to buy a home, and lots of people are renovating their homes and people are flipping their homes. And so you're going to have contractors having so much work where if they want to work at your property, they might have to charge you a premium. So that's one thing you want to keep in mind. If you are in the seller's market and the market is super, super, super hot and you don't need to do repairs right now, maybe you can wait a little while, let the market cool down a little bit, that way you can save a little bit of money on repairs. Like right after the 2020 pandemic and recession hit, there was a major materials and a supply shortage. So anybody who wanted to get renovations done or do any sort of real estate development work, it was very expensive because your lumber was expensive, all your materials were so expensive, and it was really hard to find work. But then coming into 2021, prices for labor and the materials have come down a little bit, still a lot higher than they were in past years. But just something to keep in mind is that even, home prices fluctuate, but so do labor costs and so do materials costs. And so that's one thing you want to keep in mind if you don't necessarily need work done right now. Now, does that mean that prices for labor and materials are guaranteed to go down? No, but it's something you really just want to understand what's going on in the market and how urgently do you need the work right now, because if you need work when everybody else needs work, then you might have to pay a premium to get that work done. If you enjoyed this video, here's a video on the housing market that I think you'll love, and while you're at it, download our free money management PDF, and as always, keep hustling. In the beginning, your monthly payment will be very low. You can have these monthly payments that are a fraction of what you would be paying otherwise. At this point, many people would then ask their banker, what happens if interest rates go up and I can't afford my monthly payments anymore? And the banker would always say something like,